All right, good afternoon, everyone. My name is Will Torrance, Senior Director of Sales on the Annuity Life and Long-Term Care team here at Pinnacle Financial. And what we wanted to do is give you a strategy that you may have heard about. The specifics of it is called premium financing. And what that involves is utilizing a life insurance policy with a loan from a bank. We have a specific program that we utilize through NIW Corp. Their specific program is called the Kaizen Method, which in Korean means small improvements or small steps to improvement. So what we're going to cover today is qualifications, placement, ideas for individuals that this might be a good opportunity for. I'll give you some specifics on where those opportunities might lie. And then what I'm going to also do is I'm going to show you some of the calculations on their main website. Now, just some housekeeping items here. This is something that you can't access unless you're contracted with the life insurance carrier. And I should have said that from the beginning. The life insurance component of this program is through National Life Group. We utilize an IUL or an Index Universal Life Policy as the quote unquote funding vehicle. And then the NIW Corp and Kaizen program provides the bank lending. They have all of the banks already in agreement to be able to bring that lending to the policies that we would offer. And any questions that you might have with respect to the specific program, please type them in and I'll try and answer them as we progress through the presentation. This is going to be a free-form presentation. I don't have any preset slides. So obviously, like I said, if you have any questions, please type them in because I'm going to be jumping around a lot. You might have some confusion on some certain things. So definitely don't hesitate to type those in. I might not answer them right away, but I will definitely address them at the end of the presentation. So I wanted to start with a public website that you could actually go to now and access some of the educational components of the actual Kaizen program. Now, I can't play them today because if I was to try and have you access the sound of the videos, I would have to have every individual on the webinar switch out of their computer audio, or if you're calling in from the phone, to try and sync up with our computer audio here, and the clarity on the videos is poor at best. So I just wanted to show you here. This is a client testimonial of an actual policyholder. This is the trust structure video. So I should take a second while we're here on this video here. The way that this is set up, it's an irrevocable life insurance trust. If you're not familiar with an irrevocable life insurance trust, my contact information, if you have a pen, is 800-772 6881 extension 7790. Once again, 800-772 6881 extension 7790. I can explain to you the irrevocable life insurance trust and why it's utilized in this solution. One of the other requirements in order to be able to utilize this solution is no matter what state your residence is, you will have to obtain a Nevada non-resident life insurance license in order to access this solution. The reason for that, and I won't get into too much detail, we can discuss it offline. Nevada has more advantageous trust laws than any other state in the nation, Florida being another one, but they are a little bit more difficult. So no matter what state the client is in, the trust will be administered through the state of Nevada. And like I said, if you have specifics and you're not familiar with the revocable life insurance trust, we can go into the details of that. But ultimately, the life insurance is held inside the trust. Once the loan provision, which I'll get into in a second, has been satisfied, the trust releases the life insurance policy to the individual policyholder. All of the death benefit, cash value, and components that make up the policy then become free and clear to the client. Also, by having it inside of a trust, it avoids probate and other onerous types of things that you're trying to assist with an individual that is a little bit more in line with this solution and would be a good candidate. So, just getting back to why I wanted to show you this YouTube channel is specifically this right here. This video right here, I'm sure a lot of you are aware that interest rates have been going up since the beginning of the year. So you're probably asking yourself a question, if I'm getting a loan from a bank, why would I do this right now? Because interest rates are high. I don't want to be borrowing money from the bank when interest rates are high. Dean Wamwell in this video right here explains to you the reasons why this can still be a viable option, even when interest rates are high and dependent upon the fact that you are borrowing money from a bank with higher interest rates. I would encourage you to watch that video. Like I said, it's public. You can go there now after the webinar, view it. Dean gives a very good explanation of how this solution can continue to work even in a high or rising interest rate environment. So I'm not going to go through all of this, but you can see there's tons of videos on here. It would take you a really, really long time to go through all of them. Look at the titles of the actual videos themselves. If you think that you have some clients that might fit the title of the video, I would encourage you to call me. We can discuss the client. And then obviously the caveat is going to be, are they healthy? Number one. Number two, do they meet the income requirements? Because this is not for someone that's making $25,000 a year or is on government assistance. This is someone that has the wherewithal to be able to take on a bank loan for 15 years, has the requisite premium to be able to fund the policy, and then, like I said, has the health that would justify the cost. So just wanted to show you that first so that you have an indication. Up here, this is the YouTube channel. So I can provide you that link if it's not showing up. It doesn't look like it's a real easy link to access. But if you typed in NIW Corp and YouTube channel, it will allow you to access this site. And there's a plethora of information here that will give you some background on the actual program. Here is the main website. Now they're transitioning away from this website to the next website that I'll be going to in a second. This was their original website where what you would go into is you could see the offerings. Obviously, there's an estate planning component that this could be utilized for. This could be used for business planning, for small business owners, for key man insurance, retaining key employees, partner buyouts, succession plans, future liabilities and deferred compensation. One interesting thing that has not been implemented yet, but they're working on the capacity for it, is that Kaizen or NIW Corp is working on a program where you could actually access this solution with key employees and their contributions could be deducted from their payroll. It would make your life very, very easy. Client doesn't have to write a check. It's deducted from payroll. It can be discriminatory because this is a non-qualified ipso facto deferred compensation plan for the key employees. So technically what you can do is it can be offered to your higher earning individuals, and the company gets a tax write-off for any of the premiums that are submitted on behalf of the client. So that's just a good example. Obviously, for an individual, this could be a retirement component. Now, I'm going to make one claim here because some of you might be thinking, I've heard about IUL as a retirement planning vehicle. They get tax-advantaged income out of the cash value. I'm going to stop you right there if you're going to be considering this as the primary retirement funding vehicle for a client, because if you do consider that, it's time to stop right now. Don't even progress going forward unless these few parameters are met. Number one, the client is already contributing to either a corporate sponsored retirement plan or an individual IRA. That's point number one. If they're not maxing it out, then I wouldn't consider this strategy as a viable one for an individual. If they are maxing out their retirement plans, they have maybe a brokerage account with a financial advisor, and with the stock market the way that it is right now, they don't want any more risk. Here's an opportunity for you to transition that non-qualified money that is in a brokerage account into this funding vehicle that has no risk, no downside risk, accumulates cash value, and is accessible because you're using non-qualified money already taxed as a retirement complement. Now, the final point that I would make too is if you're dealing with higher net worth individuals that are making a certain level of income, they're not eligible to do a Roth IRA. The IRS doesn't allow them to do that. I won't give you the limits, but they've changed them again this year. But I think for a couple, the limit is like almost $200,000, and for an individual, it's like 120. Those aren't the actual numbers, but basically the point is, if you make too much money, you can't open a Roth IRA. This could be your Roth lookalike, so to speak. But getting back to my point from a couple minutes ago, if your client is not already contributing to some type of savings for retirement, this cannot be and should not be your primary retirement funding vehicle. Let me just check and see if anybody has any questions because I went through a lot right there. Okay, I don't see anything immediately, so I'm just going to move forward. Once again, as I said, this website that I'm showing you is ultimately going to be transitioned away, but it just gives you some information. This is some information on NIW Corp itself. They facilitated over $5 billion in loans. They've survived through the dot-com, banking, and pandemic disasters. They have the highest persistency in the industry, and they don't sell something. It's something that works really well for the individuals. Now, if you want anything about the corporation itself, obviously you can see it's been in existence since 2000. This is a strategy that's been out there for 23 years now, but it's actually been in existence before that. The reason that NIW Corp got into the industry is because premium financing itself, the concept, 8 out of 10 policies or solutions that are offered never get placed. The reason why they never get placed is, I'll give you the reasons right now. Before a life insurance company, and most life insurance companies offer premium financing, you and the client have to go to a bank and get a lending agreement. Imagine the conversation that you're going to be having with a client where you present this solution to them, and then the next step is, oh, we've got to go to the bank and get a loan agreement. That's why 5 out of 10 fall off. Number two, if they're amenable to going to get a loan agreement, the possibility of the policy not performing, especially now with the high interest rate environment, they might have to post additional collateral in addition to the loan agreement. There's where another two fall off. So that's 7 out of the 10. The final one occurs in the process of going through all of the basically financial autopsy, so to speak, where the company requires all of this income documentation, tax returns, and everything else. That's where the final one falls off. In that 8 out of 10 individuals, also, this might take 6 months, 7 months, 8 months to place. So most individuals become very uninterested in this after, say, 2 months, or they have to submit to a thorough underwriting or a health screening, and they are higher net worth individuals, and they come to the conclusion, why do I want to do that? I'll just invest it. So the reason I'm telling you all of this is that if you try and do this on your own, I'm not trying to be harsh, but if you don't have any knowledge of this, you will fail. And you will wasted a lot of time and exertion in trying to place a policy for an individual that might seem like a candidate, but in reality is not. What NIW Corp does is they've simplified the process. In simplifying the process, though, there are some things that you might find negative. The negatives are this. They take 30% of the commission right up front. So the reason I'm telling you that now is this is not something where you're going to collect all of the commission. But there is a silver lining to that. The premiums on these policies are potentially really, really large. So if you're getting 70% of, say, $50,000, that's worth the time. The other reason that NIW Corp is taking 30%, they do all of the trust administration. There is no lender agreement that needs to be obtained by you. Like if you hearken back to what I was saying, 8 out of 10 of these normally fail. You don't have to take the client to the bank and get a lender's agreement. That is all part of this process. They have the lenders in place that are ready to lend the money, eliminating that potential pitfall for you. So you have to kind of weigh the positives and the negatives. Yes, they are taking 30% off the top, but what they're doing is they're facilitating placement of these policies where if you try to do it on your own, like I said, I'm not trying to be harsh, but you're going to fail. So just want to be very transparent with you that there's going to be a lot of requirements. I can help you along the way with those requirements, but we need to have a solid candidate in place before we would even consider moving forward. So we'll transition out of that. And now we are on the password protected website of what's called the Interactive Learning Information Assistant for NIW Corp. So this is the dashboard. This is a client presentation that I want to show you. Now, we're not going to play the video, like I said, because the volume isn't going to work, but I just wanted to show you what this capability offers. So as that's loading, you can see this is an individual that is actually a policyholder, someone from a leading top 10 US bank and an actual client. So this is how you would start your presentation. You would start with this video, which gives the background and the tenets of the Kaizen program. And I'll go into those in a little bit more detail because, like I said, the volume on the video is not going to marry up nicely, but this gives all of the backdrop of the actual program itself and would be a starting point for you in doing the presentation. So this page right here is the enrollment. I'll just show you kind of some basics of that because gets pretty complicated. So I'm not sure why it's not. Okay. So that was the video. Like I said, this is a little bit free form, so I'm just going to go through some of these buttons. This is the calculator. We'll come back to that in a second. This is the enrollment documentation. I'm not sure why it's not loading. Doesn't matter. So that was the introduction video there that I showed you. Here's the estimated benefits. Here's the financial solution. So this is going to give you an idea of how this works. This is more of an informational deal, showing what a potential client's obstacles are. Now, this is a little bit dated, but I have updated information that I could provide to you, but it doesn't discount the fact that most Americans are dealing with this. The solution here is the Kaizen, combining the leverage with cash value accumulation in a life insurance policy. Protects against a medical emergency or an untimely death. Medical emergency obviously would be something where you might need long-term care. There is a long-term care component that is attached to this. Second point, the retirement income. The cash value accumulates. It's hyper-accelerated by the fact that you have a bank loan and you're contributing some of your own money, or just having disposable income to utilize at your discretion. Here are a couple of the financial questions that it answers, and it goes into the obstacle and the solution once again. I'm not going to go through all these, but you can see them here. You're not saving enough. Medical emergencies. Where will taxes be when I retire? I need more choices. Where to put my money? That goes back to what I was talking about previously, where if they're contributing to the retirement plan, they have a brokerage account, but they're a little bit skittish about what's going on in the market right now. That's where they could carve out some of that money from the brokerage account, de-risk that money, use the leverage of the bank, have a tax-advantaged cash accumulation account that they could utilize for their ultimate retirement needs. So how does it work? Once again, this is another video. It just kind of gives the basics. It's only 2 minutes and 45 seconds, but it gives you kind of the idea. I'm going to show you in a little bit how it works in the estimating of the benefits. Here's a little bit more about the plan details. This is where I can help you. There's an illustration component where we determine the contribution amount. You fill out the paperwork, go through the medical underwriting. Now, they make that sound really, really easy, but if we have the right type of prospect, it really can be that easy. Then what's going to happen? The trust creation. The contribution from the client and the bank is sent in, goes to the Provident Trust Group. Your trust is in a bank account, and then the trustee sets up the account for any of the contributions that are coming in from the policyholder and the bank. So here's a little bit more of a description of how the contributions work. The bank account and the lender sent to the insurance company the premiums, policy issued and assigned to the lender the trust until the loan repayment agreement has been satisfied. These are some of the additional protection features that are inside of the policy itself. I'm not going to go in. This is all kind of like legalese stuff, so I don't want to really get into it in too much detail. If you have more specific questions, I can go over those with you, but just giving you kind of some of the semantic stuff so you have an idea of that this isn't a simple process. There are some steps that have to be accomplished, but it's not impossible if we have the right type of client. Once again, these are some testimonial videos. Those go back into, there's some testimonial videos on that YouTube channel that I showed you before, but the nice thing about these testimonial videos, if you get appointed, you can actually use these in social media, email campaigns. They have written testimonials that you can send out to potential clients. I would encourage you that the videos are probably better than a written testimonial, because one of the accessible items in here, which if you get contracted is really, really neat, is that you have your own landing page that you log into. And if you send out an invitation to a client, you can actually see if they've viewed the video or opened the video first. Next, you can see how much of the video they've actually viewed, and you can actually send them an enrollment or an invite to go in there and fiddle around with the estimate. Actually, it's an invite that gets indicated to you, and then you send them a link, and then you can do the estimation of benefits, which I'm going to show you here in a second. So these are the written testimonials. They have the news and social posts. You can do these on LinkedIn. In fact, I follow NIW Corp on LinkedIn. They're constantly putting out these brief little information snippets, which are highly valuable for individuals to view. In fact, they just had this one the other day. So these are just nice, quick one-pagers that you can post on LinkedIn. It gives kind of a teaser, so to speak, for the individuals. And then there's some frequently asked questions, the program details. I'm not going to go into all this. Once again, if you have specific questions, I can tell you about it, but you can see that they pretty much handle all of the questions that the client might have. These are the contributions and payments. Frequently asked questions, I can tell you about those. The bank loan questions, I can tell you about those as well. So what we're going to do right now, we're going to go into the estimate of benefits section. Now, you don't have access to this yet. If you get contracted and you actually have to, in addition to getting appointed with National Life Group, you also have to sign an NIW Corp sales agreement. You're not signing your life away. It's just basically, if you're approved, you can't take this material because it's all copyrighted. You can't take the material and then use it on your own. It all has to be utilized inside of the NIW Corp umbrella. It's just one of those non-disclosure type of agreements. But needless to say, you don't want to take this ancillary stuff and try and do it on your own, because if you were to separate your agreement with NIW Corp, you're also separating your trust administration that they do, the access to the lenders. You'll still have your appointment with National Life Group, but they won't entertain you doing any type of IULs with a premium financing component. So I'm going to stop real quick and see if there's any questions. I know I'm covering a lot, guys, and this is a high-level type of situation, but I don't want to keep you on the phone for very long. It would be much more productive for anybody out there that sees this as an opportunity to talk to me directly, and then I can give you some of the insight that I've gathered over the last 15 years that I've been dealing with this concept, and we can determine if we have a viable candidate. But I wanted to show you this estimated of the benefits section because this does a really good job. So what I'm going to do, I'm going to just use kind of a good target market. They say the target market is 35 to 65, 65 being the max. The reason that they max it out at 65, because if you remember, or actually I didn't bring it up too readily, but there's a 15-year loan repayment agreement on here. So if you're 65 years old, I don't necessarily believe that adhering to a 15-year loan agreement is necessarily going to be the best recourse for you from a solution standpoint, because you're not going to have access to the cash value of the policy until you're 80. Now, there might be circumstances where you have a very healthy 65-year-old. They want to de-risk portions of their portfolio. Okay, we can have that discussion and we can determine if that type of individual is going to be a good candidate. Now, I did run an illustration today for an agent that had a 65-year-old. He had too much risk. He didn't have enough life insurance. he has children and grandchildren. Okay, that situation could be a consideration. He's de-risking, but he's still working, so he's still taking an income. He does have retirement plans in place. We have also considered utilizing an annuity for part of his income needs when he does retire and stop taking his salary. And he liked the tax-advantaged income, and his parents lived into their late 90s. So all of those factors coming into play, that individual might be a good candidate and he's in relatively good health. But I'm going to use a 50-year-old. You choose male or female. Now you'll see here, here's a minimum contribution. So the quick estimator works for increments of 5,000. So what they're telling you here is for a 50-year-old, in order to be able to qualify, you need to be able to contribute at least $25,000. Now, you can use this. Now, we're probably not going to do 200,000, but this is flexible. Based on their net worth, their income, their savings, we can adjust this. Now, if you have a really, really high net worth individual, maybe they have the ability to contribute more than that. Now, we would have to get a special exception for amounts that are above a certain limit, but they will do that in certain circumstances. Now, I would tell you that the individuals that are going to benefit the most, and if they're making a good amount of money, is someone in their late 30s, early 40s. But that's just a general disclosure. So we're just going to say, let's do the 40,000 just to start. So what this does is it gives me a quick estimation of the results. So here are the contribution totals. As you can see here, the 50-year-old male is contributing $40,000 a year for 5 years and then is done. So it's a 5-year funding. They're done funding the policy after 5 years. Here's the lender. So the bank is contributing for the first 5 years less than the $40,000, and I'll show you the numbers in a second. Then they take over complete funding of the policy. This is where the leverage comes in, really comes in. It's still here, but now it really comes in here because you're not funding it anymore. And they're basically doubling what you're doing. So here are your client's contributions year 1 through 5. We put in $200,000 of our own money. Now remember, this is already taxed money. You're not going to get taxed on it again because you're using non-qualified funds. The lender contributes $29,810 years 1 through 5. So you remember we were contributing 40. The lender's contributing a little less than that. But then in years 6 through 10, they're putting in $68,460 for another 5 years. So they're contributing $491,350. So we've contributed to this policy over a 10-year period, $691,350. Now I'm going to give you just the legal things here. Here are just some of the semantics of the actual illustration. They're assuming a growth rate of 5.92, which is reasonable. I have a feeling with AG 49B, which is a new disclosure out there, that they're probably going to lower that estimated growth rate. But 5.92 is not out of bounds. The historical rate of return of the S&P 500 is actually around 5.7%. So they're not going too extreme. The distributions for the 50-year-old will start at age 65. Harken back to what I was telling you about with respect that this is a 15-year loan repayment agreement. So it's free and clear to this client at age 65 or after the lender loan has been repaid, typically the 15th year. If the policy, but I would encourage you not to ever say this to a client, if the policy performs robustly, then that loan can be repaid prior to the 15th year, but I would never bring that up in a presentation. We're assuming a long-term capital gain rate of 20%, an income tax rate of 37%. The reason those are so high is because we're assuming that this individual is making a good amount of money, has a significant amount of assets. So we're just going with the highest capital gains tax rate and indirectly not the highest, but next to the highest income tax rate. There's a management fee of 0.5%. The index includes all costs of insurance and fees. Policy distributions shown are the tax-free policy loans. I don't like using tax-free. It's just my personal opinion. I like calling it tax-advantaged because there are some caveats in there that if they were to access more than a certain amount, they would pay taxes on the amount above that. So I like the phrasing of using tax-advantaged rather than tax-free. Like I said, just my personal opinion. There is a minimum contribution of amount of $20,000 and the participant trust to be established as part of the plan. Here's the cost, annual cost for the trust. And then obviously all of those costs would drop off at the end of the 15th year, or approximately the 15th year. And then just so that we're giving full disclosure, the applicable federal rate is the minimum regulatory interest rate that must be charged on split dollar plans. This is technically what is called a split dollar plan. If you don't know what that is, once again, you can call me at 800-772-6881, extension 7790. Next, what we're going to do is we're going to go into the benefits and distributions. So once again, remember we were the client contributing $40,000 for 5 years for a grand total of $200,000. We're considering an internal rate of return of 8.61%. The 5.92 on the previous page is the assumed rate. This is them just projecting the internal rate of return, net of taxes and costs. The reason that they're doing that, once again, in this description, it compares more likely to investments and stock portfolios. So the initial death benefit for the client based on the funding is $978,731. The tax-free distributions or tax-advantaged distributions between age 65 and 90 are $45,000 a year. So for 25 years, this client, for contributing $200,000, will get $45,000 a year. Now, obviously, it's an estimate taken annually. Here are the cumulative distributions. So, just getting back to what I was saying, for $200,000 contributed, this client will have been able to distribute tax-advantaged $1,170,000 over a 25-year period. There is a residual death benefit, too, at age 90 of $586,649. So technically, your real value is in excess of 1.9 million. Or sorry, 1.7 million. These are the legalese again. This is the coolest thing I think that's in the comparison tool. This gives you a real estimate, once again, an estimate hypothetical, in comparison to other investments. So here's our comparison. So our $40,000 for 5 years, here's our piggy bank right here. So we've distributed $1,170,000, have the residual death benefit of $586,649. Here's a traditional IUL. We have received $832,000. We have a residual death benefit of $204,667. But remember, in order to get those distributions, The client has had to fund out of pocket that full amount in order to get a similar comparison to the Kaizen. So they're not contributing just $200,000. They're probably contributing more than that. Here's an after-tax investment, brokerage account, maybe real estate, maybe options, maybe anything. So anything that has already been taxed. Here's our distribution amount, $582,401. No death benefit. It's just an investment. So your real value in that regard, which I'm not discounting, I still think that you need after-tax investments, but that's what I'm going to go back to the very, very beginning of the presentation. If you do not have savings, this should not, right here, this should not be your primary savings vehicle, because we're distributing $45,000 a year from 65 to 90. Is that enough money? I don't know. Couple that with Social Security. Is that enough to live on? You really need to have other savings in place. This is a complement to that. This is your tax-advantaged complement to that. This is your Roth alternative, that you're making too much money, you can't contribute to a Roth. This is that accessible option for you that provides that tax-advantaged income. Now remember, it's not guaranteed for life. This is a component of your retirement plan. The only option that provides you income for life is an annuity. So we also offer annuities. So if this $45,000 plus their after-tax investments, plus here's the final one, a tax-deferred investment, which is the annuity, you can get $713,290 of distributions. Once again, no death benefit. That's your IRAs, your 401ks, your SEP plans, the tax-deferred vehicles. Now, the problem with the tax-deferred vehicles is that you have to pay taxes on every distribution. It's not guaranteed for life. So another option that complements very nicely with this is transitioning your tax-deferred investments, if you're becoming risk-averse, into an annuity that has guaranteed income for life that would give you a prescribed annual income that would couple nicely with this. Then what we're really doing is we're giving them this component, which is tax-advantaged. You're still going to pay taxes on a portion of your annuity payments, but these two things together technically don't lose value because zero is the floor. They are not invested. They are insurance products. So in a comprehensive, well-designed plan, you need a little bit of all of this. The percentages that you have in all of these is where I can help you make a determination. So that tool is extremely cool. I think it's just one of those things where when you're doing the estimation of the benefits, go back out. All right, let me go back in. Sorry. Okay, now we're back out. So you can play around. You don't have access to this yet. If you get contracted with us, you get approved by NIW Corp, you'll have access to this plan comparison tool. Now, remember what I was telling you about earlier, that if you had a client that you sent out an invite via email, they have the database customer relation management software here, that if you send the email from this website, it tracks if the person opened the email, if they viewed the ancillary that you put in there. Maybe it's a video, maybe it's a PDF attachment, it really doesn't matter. You can then send them an invite, and then you can share your screen and do this, the plan comparison. Pretty slick. So that's pretty much it. I don't want to go into too much more. I wanted to give you kind of a 30,000-foot view of this. Things to remember, just so that we're not putting the cart before the horse. The right types of individuals. Individual that is contributing to a savings plan already, be it at their place of work, individual retirement plan, brokerage account, they are saving. They're saving some kind of money. Doing an assessment of how much they are saving, and then doing the assessment of, are they making too much money that they can't contribute to a Roth IRA? Those are our starting points of determining whether or not we have a viable candidate. Once we've done that, we have to determine and be our own best friend from an underwriting perspective. Are these people wildly unhealthy that they're never going to get approved? Okay? Completely takes this solution off the table. We have to do that up front. We can't offer this solution to an individual and then backtrack and find out that they're just way too unhealthy to do that. I'm going to stop because I saw a question come in. Okay, so I got a question. Yeah, this is good, Jerry. This will apply to everyone. When and how does the loan get paid back? So the loan, if I'm just being standard, it's paid back at the end of the 15th year or in the 15th year. It is paid through the cash value accumulation. So whatever cash value has been accumulated in the life insurance policy is utilized to pay back the loan. So hopefully that answers your question. We can get into some more details of the semantics of that. There are some little caveats. They're not caveats in a negative way, but they put in buffers that specifically protect against this high interest rate environment. The other way that they protect against the high interest rate environment, this is not a personal loan. Each policy holder, and they have different dates that they issue this. This is why it's not a short-term program. They have what they call tranches every month. What they do is they combine every applicant into a tranche. They then take every applicant and the amount of premiums that are going to be contributed, and they go to the bank. So let's just say we have 80 individual applicants that are contributing X amount of premium. They take those 80 people, they go to the bank for a jumbo loan. So let's just say the loan is for $50 million. The $50 million, because NIW Corp has been working with the top 5 U.S. banks for the last 23 years, they get preferred loan rates. So you're not paying what the current loan rate is on a mortgage right now, or even a personal loan. This is a bundled loan that the bank feels safe because if one of the policyholders of the 80 flakes out and doesn't adhere to the program till the end of the 15th year, they still make their money back in interest and the death benefit goes away. Or, sorry, it doesn't completely go away. It gets graded based on the amount of premium that the client has contributed. So they might get a small amount of cash value minus the loan, but that actually, I should have said this at the beginning too. If someone doesn't have the stomach to lock up their money, so to speak, for 15 years, then that negates them from being a good candidate. So, final answer on that, by bundling the loans together, you are not paying the highest interest rates that you would be doing if you tried to do this on your own. The top 5 U.S. banks that NIW Corp works with, they're ready to lend this money. They do it in this regard because it protects the bank. And in that way, the client, if they adhere to the standard, makes out very, very well. So I hope that answered your question, Jerry. So I'll give you all another 2 or 3 minutes to kind of compile your thoughts. I know that we've covered a lot of information in a short period of time, but if you have questions, once again, my name is Will Torrance. My number is 800-772-6881, extension 7790. If you have a client that you're thinking about right now, call me. We can discuss it. I'm going to be blunt with you on whether or not it's even worthwhile because I don't want you to waste time. These are long processes to get these issued. So we don't want to spend a ton of work on something that is just going to die on the vine. So I can do that. I can help you with the assessment right from the beginning, and we can kind of head off something that's not going to be productive for you or productive for the client. Other alternatives as well, if you have a client that likes the concept of having tax-advantaged income sometime in retirement, but they can't stomach or can't afford the 5 years of premiums that this does, we can always cater an IUL, an individual IUL for a client, which could be that alternative for them. But I would say if the parameters that I set earlier about people saving money, having these investments already in place, and they have disposable income that they really don't want to plow back into the market, this could be a viable option. Final thing too, just as kind of a standard bearer, just be thinking about people that are making $100,000 a year, or you could have a small business owner that's taking a small salary and is plowing the revenue back into the business. If the business is worth a certain amount, the income that that individual is taking disregards that income requirement. So the individual would be the income requirement. The business owner would be the revenue generated, because there's a lot of business owners that don't take a large salary that might not apply on the surface for this. But the revenue that's generated, you're plowing that back into the business, taking a smaller salary because you're trying to grow the business. So there are little nuances that we can play with that would be able to either justify this for the client, especially from the tax savings perspective. So if a small business owner is taking a small salary and they're plowing more money in revenue back into the business, they could get a tax write-off if they used part of that to fund this policy, either for a key employee, a buy-sell, Section 162, 7702. I can go into detail with those. Those are IRS codes. 147 plans, split dollar, which is basically what this is. There's a lot of options, so to speak. So I don't see any more questions at this time. I appreciate you all attending. I'll just leave you with my number once again. I know I've probably said it ad nauseum, but it's 800-772-6881, extension 7790. Please feel free. Oh, sorry, someone asked my email address. Sorry. My email address is wtorrance, TORRANCE, at pfsinsurance.com. I'll say it again. wtorrance, TORRANCE, at pfsinsurance.com. All right. So thanks once again, everyone. I will be sending out a replay of the webinar. Final point, I'll say, if you can't access the NIW Corp YouTube channel, send me a quick email or give me a call. I'll send you the link. I think that that's a good second step in this process, giving you a little bit more meat on the bone, so to speak, of the concept. And if you have any other specific questions, please feel free to reach out to me and I'll be more than happy to help you. Everyone have a great day and a great weekend, and I look forward to working with you in the near future. Thanks and goodbye.